IPOs are a trap for retail investors, and in this video I want to go ahead and break down why I'm not too fond of investing in a company the day it IPOs. However, it may be okay to trade it, and I'm going to go ahead and break that down by using an example of a stock that just IPO'd today. But before we go ahead and hop into my laptop and look at this example, I want to share this quote from a famous trader by the name of Jesse Livermore, who once said that Wall Street never changes. In fact, he said that the pockets change, the suckers change, the stocks change, but Wall Street never changes because human nature never changes. Now, I shared that quote because I find it very appropriate for the conversation of IPOs, and I want to go ahead and hop into my laptop and talk about what we saw today. Alrighty, so we are in my laptop taking a look at ticker symbol ARM, which is a stock that IPO'd recently today, and it's arguably one of the largest IPOs that we've had in a while. Of course, in the future, many more are more likely to come, but this was a huge one that started publicly trading at around 12.09 today. Now, I want to go ahead and explain why there are opportunities in the short term. However, in the long term, I'm not too fond of investing in a stock the day it IPOs, right? And the main reason is because many market participants, especially, I'm talking about retail market participants, believe that when a stock is IPOing that they're getting first dibs on it, and that's actually totally incorrect. In fact, there's a whole hierarchy of individuals and institutions that get involved before it even gets publicly traded. And so I want to just quickly go over the hierarchy, and then of course then explain the reasoning behind why I'm not too fond of investing the day of, right? So in the early stages of a company's growth, you have angel investors, which are just individuals with a lot of capital. You have venture capitalist firms, which are funds that just have a lot of capital that they manage. And what they do is they look for these companies in these early stages to buy shares long, way before the company goes public, right? So those are the first initial people that actually get involved. Then you have private equity firms, where as the company grows, it might also secure investments from private equity firms. And these firms can invest at various stages of the company's development, but most of the time it's way before it IPOs. And then of course you have the employees, in many cases where the employees of the company are offered shares or options to buy shares as part of their compensation package, right? And so this is all pre-IPO stuff. Then, of course, you have the IPO process, where you have underwriters, which is basically when a company decides to go public, it works with an underwriter, which are typically investment banks, to handle the IPO. And these underwriters have a significant role in determining the initial offering price and may have early access to shares, right? And then, of course, not only that, then you have, I know it's a long list, you have institutional investors, where before the shares are available to the general public, these institutional investors, think like mutual funds and pension funds, etc., get a chance to first buy in before the IPO, right? And this is typically what's referred to as a roadshow, where the underwriters and companies and executives pitch the IPO to potential large investors before it actually gets publicly traded, right? And so you actually have a long list of people that are putting capital into a company before you even get to have access to it. Now, most people don't know that unless you're a seasoned market participant, or perhaps you were studying for your Series 7 to become a licensed stockbroker, right? Because that's pretty much one of the questions that's typically on that exam. But that's something that a lot of people don't know. And so one of the reasons why this is an issue is because you have this over evaluation that takes place. Then there's also a lockup period, where after a certain amount of days, sometimes it's 90 all the way up to 120 days, those early people who were able to get access early on may be able to start selling off, and that could cause this hype to dwindle down, and then maybe later on we restore to the fundamentals. But in the beginning, the trading activity for an IPO is not really tied very well to its fundamentals. Now, another thing that you want to be aware of is that there's a lot of hype when a company IPOs. In fact, if we take a look at the stock today from when it opened, right, all the way to the close, it moved up 12% for today, right? A lot of hype, because there's a lot of speculators that enter into the market, and they're just in it for the short term. Maybe they're day trading, or maybe they're swing trading, and eventually once they get shaken out, they eventually start selling their position, and then of course maybe the price may reflect its fundamentals. And so if you're someone who's investing in the long term for a company, you're probably most likely not going to be getting in at a good price because things are so overvalued now. The idea though is if you're trading this in the short term, then yeah, IPOs are extremely exciting because again, there's a lot of hype and a lot of just speculation on it where you see these big swings. In fact, if we look at the big swing from today, we see that yeah, it moved up, then it pushed down, and then it aggressively pushed upwards about 11%, and then from there it ended up consolidating, selling off towards the end of the day, and then towards the end of the day and power hour, which is referred to the last hour of the trading session, we saw another huge spike up where if you would have bought in and sold at the end, that's an additional 13%. So definitely a lot of excitement if you're trading it in the short term, and then of course that's just day trading. Then you have the swing traders who are holding in, and then you see it's pushing up in the after hours, and they may hold it for a couple of days until they exit their position. But it's just a lot of volatility that yeah, in the short term it's great and it's fun to really have a good opportunity for momentum. But again, as someone who likes to also not only trade but invest in the long term in companies, I try to stay away with a 10-foot pole investing in IPOs. Now again, great to trade, but not really something that I prefer to invest in the long term. I prefer to wait for that selling period or lockup period to take place where all those early investors or market participants are able to exit out, and then wait for things to settle in where we start to see a little bit of a real price take place in terms of valuation. And if it's a great company, then I'll go ahead and invest long term. Now, I'm not going to go ahead and dive into the specifics of ARM because I think that may be best for a separate video. But with that being said, guys, if you like the information in this video, make sure to check out the pinned comment in the comment section below because there's going to be a link to join my free weekly market pulse insight where every single week on Sunday I send out an email talking about what are some things we should be aware of going into the next week for the trading week. And there's definitely a lot to really be aware of, especially if you're a long-term investor or a short-term trader. There's something in there for everyone, so definitely take out advantage of that link in the comment section below. And with that being said, I wanted to make this a quick video, so hopefully you enjoyed, and I'll see you guys on this next video right over here. Take care, guys.